and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. The Sebi board has approved the gradual phasing out of buybacks through stock exchange route. It has also chalked out governance mechanisms for addressing lapses at market infrastructure institutions like stock exchanges. So, how will these developments affect shareholders? Bhashwar Kumar brings you the answer. The Board of the Securities and Exchange Board of India on Tuesday gave its approval to phasing out buybacks done through stock exchanges. This route will be completely phased out by March 2025. After the board meeting, Sebi chairperson Madhabi Puri Buch said that the Sebi board felt that the tender route was a more equitable one for buybacks, while the other route was vulnerable to favoritism. A buyback is a corporate action where a company buys back its shares from existing shareholders, usually at a price higher than the market price. Buybacks can be carried out in two ways. One is the tender route, where shareholders may be presented with a tender offer, whereby they have the option to submit a portion or all of their shares within a certain time frame and at a premium to the current market price. The other is the stock exchange route, where the company buys back shares on the open market over an extended period of time. A buyback may be executed for various reasons. It can be to provide an additional exit route to shareholders where shares are undervalued or thinly traded. It can also be to return surplus cash to shareholders and support the share price during periods of sluggish market conditions. So, how will shareholders be affected by Sebi gradually phasing out share buybacks through the stock exchange route?
The tender method is the most favorable method of buyback from an ordinary shareholder's perspective, especially the retail shareholder. Whereas the market buyback was generally abused by the managements to manipulate the sentiment when the stock was under pressure. So I welcome this latest move by Sebi. It would have been better if they had abolished it from the next quarter itself. However, it's good that they have increased the minimum buyback limit and are creating a separate window for such market buybacks.
Sebi has given its go-ahead to increase the minimum utilization of the amount earmarked for buyback through the stock exchange route, from the existing 50% to 75% until the route is completely phased out. Until then, buybacks will be executed through a separate window on stock exchanges. The markets regulator will also permit the upward revision of the buyback price until 1 working day before the record date. Furthermore, the period for completing the buyback offer will be reduced from 6 months to 66 working days from the 1st of April 2023. It will be further reduced to 22 working days from the 1st of April 2024.
In the general market window, anybody can be a buyer, whereas sellers are those who are registered shareholders or short sellers. But in the special buyback window, there can only be two groups. Buyer is the company itself and nobody else. And the seller has to be an eligible shareholder who will have to deliver the shares at the end of the day, since there is no square-up mechanism in the window. And since the company will now have to complete the minimum fulfillment of 75% of the planned buyback, there will be pressure on the company to pay a premium on the market price to achieve this target. Although complete details of the window operation is not available, I assume it will be accessible only to those eligible shareholders as on the record date.
Overhauling the governance mechanism, Sebi has also laid down measures to increase transparency and accountability at market infrastructure institutions like stock exchanges, depositories, and clearing houses. Under the new framework, board members and key management personnel will be held accountable if they do not report any wrongdoing that they are aware of. A sharper code of conduct will also apply to market infrastructure institutions, key management personnel, and board members. An internal evaluation of market infrastructure institutions will have to be conducted every year, while an external evaluation will be conducted once in 3 years by an independent entity. Furthermore, the institution's chief regulatory officer will be required to submit a quarterly report to Sebi on non-compliance, if any. Market infrastructure institutions will also be required to frame an internal policy for sharing and monitoring data.
This move by Sebi and its board will definitely benefit shareholders and investors, as it will bring much more clarity and sharpness to the day-to-day functioning of the MIIs. It also reduces the risk of challenge for future actions, as we have seen for certain institutions in the last few years. And more importantly, KMPs will be identified and have to take responsibility, but arguably this will avoid conflict of interest for them, because they will be focused on either the critical functions of the stock exchange or the regulatory and compliance functions or other functions. Hence, overall, this is a positive move which will bring more clarity to the functioning of these MIIs, and that will result in better returns and better governance for an organization, which always benefits shareholders of such organizations.
The Sebi board also decided to designate stockbrokers based on identified parameters as qualified stockbrokers. These stockbrokers will need to comply with enhanced risk management practices and requirements. About 16 brokers will fall under the qualified stockbroker category under the suggested parameters. The regulator will also provide an investor risk reduction access platform that will help clients in squaring off risks in the event that the trading services provided by a broker are disrupted. It is expected to be available from the third quarter of FY24. Sebi's decisions should streamline the buyback process and create a level playing field for investors. The steps to improve governance at market infrastructure institutions are also significant given the past failures and controversies at the National Stock Exchange and Multi-Commodity Exchange. The changes in the governance norms are going to be beneficial for retail investors and increase the transparency of markets. Meanwhile, Business Standards BFSI Insight Summit, which returns to in-person mode this year, was kicked off on Wednesday with a keynote fireside chat with the Reserve Bank of India Governor Shaktikanta Das, moderated by our consulting editor Tamal Bandyopadhyay. Here are a few excerpts from the chat.
Very warm welcome to this fireside chat. I remember in November last year, we had a fireside chat with you, and there very strongly you waged a war, if I may say so, against cryptocurrency 13 months back. So you have won the battle, you think?
No, there is no war or anything like that. You see, we firmly believed and do firmly believe even now that cryptocurrencies have absolutely no underlying, and we have been pointing it out. And the developments over the last 1 year, including the latest episode of the built around this FTX, I think after all this, I don't think we need to say anything more about our stand. I think the time has proved that cryptocurrencies are worth what they are today. But I would like to just mention 3 points. One, the origin, the cryptocurrencies, the private cryptocurrencies owe their origin to bypass the system, to break the system. They don't believe in the central bank, digital central bank currency. They don't believe in the regulated financial world. They want to bypass and beat the system. The second thing is that they have absolutely no underlying. And not only that, I am yet to hear any credible argument about what public good or what public purpose it serves. There is still no clarity about it. And third, as I have said, it's 100% speculative activity. And I would still hold the view that it should be prohibited. I mean, countries have been taking different views, but our view is that it should be prohibited, because if it is allowed to grow, that if you try to regulate it and allow it to grow, please mark my words, the next financial crisis will come from private cryptocurrencies.
Can you just very briefly explain to us, I mean, how do we, what's the use of CBDC? Because you said it's currency, it's like currency notes, it's anonymous, and that's it. But what is there? I'm happy using UPI and all. Why do I shift to CBDC? It's just an optic to fight crypto.
The first thing is UPI is a payment system. CBDC is a currency itself. That is number one. Number two, as I explained, UPI involves the intermediation of banks. You use through the mobile, you pay somebody, then my money gets debited from, the message goes to the bank, my account gets debited, the bank transfers the money to the bank of the, to your bank account. Your bank account sends a message to you that, so much money has been received. So there is an intermediation of bank. CBDC is like currency notes. You go to the bank, you draw it, you keep it in your purse and you spend it. And what is more about CBDC is that there is an automatic sweep in and sweep out facility. 24 hours you can draw CBDC, and if you are carrying excess CBDC, you can put it back into your bank account. So there is an automatic sweep in and sweep out facility. The second or third, whatever point that may be, the third is that the huge logistics, the cost of printing around printed notes, that is not there. Manufacturing paper, getting the ink, having a printing press, all that thing will become outdated over a period of time. Logistics wise, CBDC will be much simpler, and it will be much faster. Next point is for international transactions. When two countries have their own CBDCs, it can be instant, remittance, instant money transfer between one country to another country. The whole world is going towards, is becoming more and more digital. Almost in every sphere today, you have digital activity happening. You will see in the coming decades. Now, many central banks are still in, experimental stage. They're still analyzing. Some central banks have started pilot projects. But you will see in days to come, more and more central banks will embrace digital currencies. And India has been in the forefront of the digital revolution in the current, in the current century.
So it's a currency of the future. Reserve Bank of India has two roles. One is the developmental role, meaning about the financial system stability, etc. Other is supervision and all. But of late, in private bankers says that you are becoming a bit of a micromanager.
Perhaps what you are referring to is the intense and deep supervision that we are doing. Over the last 3 or 4 years, we have really deepened our supervision. Ultimately, at the end of the day, you see, in United States, failure of banks happens. It's nothing unusual. There are cases of bank failures. It happens. Everybody takes it. In India, failure of a bank is just not acceptable by the public or by anyone. And everybody looks at the RBI. So it is our responsibility as the regulator and as the supervisor of the banking system to ensure that the banking system is stable, the banking system is robust, and it is ready to cater to the emerging requirements of the Indian economy, which has aspirations of becoming a $5 trillion economy in the next few years. And keeping that in mind, we have really I must say very clearly, we have really intensified and we have deepened our supervision methods, our supervision approach.
India's presidency at G20. So how do you see this? What are the opportunities you see?
No, I think it's a great opportunity for India. It gives India a much bigger role in the international arena, in the world stage, India has now a much bigger role. India will be chairing all the G20 meetings. It's already started. And it's a place to, also for India to play a bigger role. And I think the biggest task for the world community, not just for India, the biggest task for the world community and for G20. After all, G20 represents something like 85% of the world GDP. Now, and about 75% of the world trade. So therefore, the G20 as a group does matter a lot for the rest of the world. So what is very critical and important for the G20 as a group is to restore the trust and efficacy of multilateralism. I think over the last few years, multilateralism appears to be losing its efficacy, whether in the context of fighting COVID or in the context of dealing with various other global problems. And I think something which the G20 as a group needs to address collectively. So I think for G20 as a group, the most important thing is to restore the efficacy and trust built around multilateralism. And I think India today, whether you look at it from the point of view of the way the world is growing, or you look at it from the point of view of the current geopolitics that is happening today in the world, I think India is uniquely placed to play that role effectively.
Thank you, sir. So is confidence, optimism, and caution. Thank you, sir. So Mr. Das has completed his 4 years. Last week he started his 5th. And as and when he completes his 6 years, presuming that he is not getting another extension, presuming at this point of time, in Reserve Bank of India's 87-year history, you will be the second governor to have 6 years. So give him a big hand. Thank you, sir. Thank you.
Turning to the markets now, animal fodder prices have continued to increase this year. It has impacted not just households that depend on cattle rearing, but also dairy companies. The high fodder inflation has pushed the input costs for dairy firms. In a bid to bring down these costs, dairy companies have increased product prices several times this year. But the benefits don't seem to accrue. The big question facing the dairy sector now is, when will these benefits start kicking in? Here's Harshita Singh's report.
Elevated prices of fodder and wholesale milk continue to erode the dairy industry's profitability. For instance, the operating profit margins of Heritage Foods and Dodla Dairy dropped 482 and 230 basis points respectively in the September quarter on a yearly basis despite firm revenues. To mitigate the pressure on profits, the industry has steadily increased prices over the past 10 months. However, analysts believe the relief will only begin to trickle in from the March quarter.
Post-COVID, the dairy industry faced unprecedented inflationary pressure as the price of raw milk and packaging went up sharply due to increase in the prices of fodder with the farmers passed on, lumpy virus taking out 7 to 8% of milk supply, and increased demand due to a sharp rise in exports of butter and SMP. This put pressure on the dairy industry's gross margins in FY23, which declined from 25% plus to less than 18%. As mentioned earlier, the companies have taken price hike with some lag, and the benefits are expected to be seen in Q4 FY23, and FY24 is expected to be a normal year in terms of margins and raw milk supply.
Experts say the dairy sector will have to continue raising prices until the second half of FY23 as animal fodder prices remain high. According to ICICI Securities, dairy companies' EBITDA margins may contract by 50 to 100 basis points in the second half of FY23. Dairy companies need to raise prices again during the remaining 2 quarters and focus on increasing the share of value-added products to protect their profitability. That said, the industry has managed to fare better in terms of top-line performance even amid crunching profitability. Analysts say the sector's revenue may remain strong due to better volumes and higher sales to hotels, restaurants, and catering segments. Against this backdrop, they recommend investors pick companies with strong distribution networks and a higher share of value-added products such as ice cream, cheese, and lassi, among others.
In the dairy sectors, companies with a large product lines, wide distribution networks, and stronger balance sheets should be preferred. Such companies manage to sustain their revenue performance and protect their margins during turbulent times. Our top picks in the dairy segment are Parag Milk Foods and Heritage Foods. Parag Milk is quoting at 8.7x FY25 EV by EBITDA, while Heritage at 9.9 times FY25 EV by EBITDA appear attractive to us.
Meanwhile, on the bourses, shares of Parag Milk, Dodla Dairy, Heritage Foods and Vadila Industries have jumped 6 to 92% so far in FY23 as against a 4% gain in Sensex. Global peers will sway the mood on Dalal Street today. Investors will also track Q3 GDP data from the US and the UK later in the day.
The interoperability of IoT devices has long been limited to the same brands, but that's going to change soon. The Connectivity Standard Alliance, in consultation with tech majors like Apple, Google, Samsung, and IKEA, has introduced Matter, a common standard for the interoperability of IoT devices. Let's understand how it's going to address this pain point.
If you're planning to turn your home smart or create automated ecosystems for your office with Internet of Things or IoT, interoperability of devices is no more a barrier. The Connectivity Standard Alliance, which creates and evolves universal open standards for Internet of Things devices, on November 3rd announced Matter. It is a new protocol created to have a common standard for the interoperability of IoT devices. It is an open source protocol which allows users to connect different smart home devices and mobile apps with each other. Products incorporating the Matter standard will feature a unique logo signifying interoperability with certified Matter products from any manufacturer. Smart home devices manufactured by different companies do not necessarily work together. This leaves customers with two choices: either opt for a smart home product that individually works best for their needs but not necessarily together, or customers can buy all the smart home products from a particular brand so that all devices work together in an ecosystem. However, Matter can solve all the above problems. Matter certified products could work together seamlessly even if they are from different brands. It means, as a consumer, you do not have to stick to one brand for all smart home devices. So, if you are controlling your AC from your phone with a Sensibo air controller or battling indoor pollution with Covab Air Mega Smart Purifier, you can now seamlessly switch to other IoT gadgets that support Matter. To lock and unlock doors remotely from your smartwatch, you may soon switch between Google Nest, Smart Lock, and Acra Smart Door Lock that supports Apple HomeKit. Matter also allows users to control all the IoT devices from individual apps. This means a device set up in the Google Home will also appear in the Samsung SmartThings app and vice versa. So users no longer have to remember which app controls the lights and which controls the smart speakers. Smart home device makers would need Matter certification to make their devices compatible. Once certified, the existing smart home devices can be upgraded with software updates. Currently, the certification is available for common smart home products like smart lights, smart plugs and switches, heating and cooling devices, window coverings and shades, door locks and TVs. Smartphone apps such as Google Home app and Apple Home app will also be supported by Matter.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.